Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So once a year, the greatest investor of all time, Warren Buffett, sits down and he writes a letter to his shareholders at Berkshire Hathaway. And right here, I have the latest Warren Buffett letter, which just came out yesterday as I'm filming this video. All of these letters from Warren Buffett, they're always great. I have stacks of them from the 50s, 60s, 70s, 80s, 90s, all down in my bookshelf down there. And you learn something from every single one of them. So yesterday afternoon, on a lazy Sunday afternoon, I sat down with a beer and I read through the latest Warren Buffett letter. And in this video, I want to share my biggest takeaways and biggest learnings from this particular letter to shareholders from Warren Buffett. Now, on the front page of all of Warren Buffett's letter to shareholders, he likes to put up the annual basically performance of Berkshire Hathaway versus the S&P 500. And in this sort of front page to the letter, we go right from 1965 all the way to 2020 and have an annual performance figure for each. And this is just always a nice reminder of the long-term performance that Berkshire Hathaway has achieved. Over the period from 1965 to 2020, Berkshire Hathaway has had a compounded annual gain at 20%, right on the dot, 20.0%, versus 10.2% on the S&P 500. And that 10%, alpha is enormous. Even in a single year or in a couple of years, that adds up. When you add it up over decades and decades, it turns into something really special. So over that entire period from 1964 to 2020, if you had put some money into Berkshire Hathaway right at the start, you would now be sitting on a 2,810,526% return, which is just stupid, versus a 23,454% return on the S&P 500. So that is the magic of compounding and the magic of earning only a few percentage points even above an index over a period of time. Those things can really add up, and vice versa. If you lag the market by a couple of percentage points, or you're paying fees that sort of detract from the returns that you get to keep as an investor, that can really hurt your long-term compounded gains. Now, Warren Buffett started out this letter by really going back to basics, and that is one of the key takeaways I had from this particular shareholder from Warren Buffett, as he went right back to what are the key things that Berkshire are trying to focus on. So he went through and he detailed what made up the $42.5 billion in generally accepted accounting principles or GAAP earnings for Berkshire Hathaway. And he said that was made up by $21.9 billion in operating earnings, $4.9 billion in realized capital gains, $26.7 billion from an increase in unrealized gains that exist on stocks that they hold. And finally, they had an $11 billion loss as a write-down from a few subsidiaries, which we'll get to shortly. And he emphasized yet again, as he's done in the past couple of years, that the real focus here for Berkshire Hathaway is growing the operating earnings part of that GAAP earnings number. So the operating earnings are what Berkshire earns from all their subsidiaries, and it also includes any dividends that they get paid from their public stock holdings. And what he's basically excluding in that figure is, the annual fluctuations year to year on market prices of their stocks. There was an accounting rule change a couple of years ago that meant that, any public stock holdings that Berkshire Hathaway had, or that any company had, but it really does affect Berkshire Hathaway a lot, that basically had to be included as earnings. So if the stock market went up, earnings looked really good for Berkshire. If the stock market went down, earnings looked really poor for Berkshire. That was previously always accounted for, I believe, just on the balance sheet of Berkshire Hathaway, but now it's sort of included in earnings. And Buffett is basically telling shareholders to ignore those fluctuations year to year. Over the long term, he expects Berkshire to have massive capital gains out into the future on their stock positions, but it really shouldn't be something that is included in an annual earnings number, because it's really not representative of what the overall businesses are doing that Berkshire owns entirely, or even what the businesses in their stock portfolio are performing like. And Buffett again touched on another key kind of basic accounting principle that you really need to understand if you're looking at Berkshire as a potential investment for you. And that is this idea of what in the past he's called look-through earnings, but basically earnings that don't show up on their financial statements. So if you think of Warren Buffett and Berkshire Hathaway's investment in Apple, for example, the only income that shows up in the operating earnings for Berkshire Hathaway from that Apple investment is any dividends that Apple pay Berkshire. And it really entirely excludes the retained earnings that Apple have, and sort of it gives a very minimal picture of the overall profitability of Apple. Whereas in reality, Berkshire owns a good chunk of Apple's stock and of Apple's overall business, and they over time expect to benefit from the overall earnings of that company, which for Berkshire will be achieved through capital gains. But it's important to recognize that only the dividend income and so on is really showing up in the financial statements for Berkshire. And the final thing that Buffett mentioned in sort of the intro to this letter is a mistake that he made. And that mistake was around his purchase of Precision Cast Parts, PCC. This was one of the biggest acquisitions that Berkshire Hathaway's ever done. I don't know the exact acquisition figure off the top of my head, but I'll try and find that online and put that up on the screen here. And basically what Buffett has said here is that Precision Cast Parts is a fantastic business. It's a fine company. It earns a good return on its tangible assets, but it doesn't earn as good a return as expected on the price that Berkshire Hathaway paid. So although Precision Cast Parts is a fantastic business, and Buffett is happy with the management and happy to have it as part of the overall Berkshire family, he paid too much for it, and he did that by overestimating the potential earnings for PCC out into the future, and that is why we see, as Buffett describes it, an ugly $11 billion write-down on the most recent financial update for Berkshire. The next part of the letter from Buffett was titled Two Strings to Our Bow, and this was basically a bit of a history lesson on conglomerates. Now, Berkshire Hathaway often gets lumped into this category of conglomerates where they own a diverse range of a bunch of businesses, and that is true. They are a conglomerate. But conglomerates have historically earned quite a poor reputation. Buffett goes through and describes why that is the case and why that reputation for a lot of these conglomerates is deserved, and why he thinks that Berkshire Hathaway in this case does not fit that bill and is quite different. So conglomerates, I guess back in the day, were businesses that really often restricted themselves to entire, whole ownership of businesses. And it meant that there was a lot of competition for acquiring some of these businesses, and the prices that they might have to pay for those companies in cash just simply didn't make sense because there was so much competition. So one of the things that some of these conglomerate sort of promoters did back in the day, and I believe this happened mainly in sort of the 50s and 60s, was they basically went out and pumped their stock. They tried to get the stock price up as much as possible, and they essentially used their stock as currency. So what they would try to do is, get their stock selling at a point where it's maybe at something like 3 times intrinsic value or something ridiculous. They would then go out and sell shares and basically use that as currency, and they would buy businesses that are trading at 2 times their intrinsic value. So they're still getting a good deal and they're building intrinsic value for the conglomerate, but they're doing it with these overly inflated share prices. And Buffett sort of gives the analogy that, he will buy a $10,000 dog for you as long as he can give you 2 $5,000 cats in order to do that. That's kind of the type of transactions that were going on here. So that is really why conglomerates earned their poor name and poor reputation, but Buffett sees Berkshire a lot differently. So he sees Berkshire different, firstly, because they don't limit themselves just to wholly owned subsidiaries. Sure, they own a lot of them, but they pay intelligent prices for them, and they are also open to buying public companies, as he's done extensively over the years. And he's also really not interested in sort of controlling the business. Certainly he'll own the business, but he largely leaves management in place, leaves management to lead their own lives, and basically just tells them to send the cash to Omaha. And that's something that has allowed him to build a really good reputation for Berkshire as a home for great businesses, for entrepreneurs that might be looking to sell either part or all of their companies at some point. He says that after a 20-year struggle with the textile operation he inherited at Berkshire, he's finally convinced that owning a non-controlling portion of a wonderful business is more profitable, more enjoyable, and far less work than struggling with 100% of a marginal enterprise. And then he goes on to share an old quote from Ronald Reagan, which says, "It's said that hard work has never killed anyone, but I say why take the chance? And that's sort of the mentality again that Buffett has applied to Berkshire Hathaway. Next up, we had quite an extensive section on basically share buybacks. The title of the section of the letter was The Family Jewels and How We Increase Your Share of These Gems. And Buffett talked through a couple of things here. So firstly, he talked through one of their businesses, which is Apple. They, own that publicly. That's, a fairly transparent position for them. And he talked through the power of share buybacks. So in the case of Apple, they initially spent $36 billion in order to acquire 5.2% of Apple, of all the shares outstanding. They did that over a fairly long period of time, so from late 2016 to about July 2018. They bought stock in the public markets up to the point where they own 5.2% of the company. But they have enjoyed since then regular dividends, about $775 million a year in dividends. In 2020, they also pocketed an additional $11 billion by selling a small portion of the position. So despite getting paid all these dividends and despite selling $11 billion worth of stock, that's quite a sizable chunk compared to their purchase price, but nonetheless, they still own 5.4% of Apple compared to the 5.2% that they owned initially after acquiring their stake. So that from Buffett is just a simple demonstration on the power of share buybacks. Apple have returned a lot of capital through those buybacks, through basically increasing the ownership in the company for shareholders without shareholders having to lay out an additional cent for buying more shares or anything like that. And they've also reduced their cash pile in other ways through paying out dividends, and Berkshire even sold a little chunk of Apple as well. So that was a little bit on share buybacks. The other thing he mentioned about buybacks, which is probably the biggest story of this entire letter, is that throughout 2020, Berkshire bought back the equivalent of almost 81,000 Class A Berkshire Hathaway shares. They bought back 80,998, and they spent $24.7 billion in the process of doing that. And that, again, increases your ownership as a Berkshire shareholder, if you happen to be one, in all of the other Berkshire Hathaway businesses. So you now own a higher percentage of Berkshire Hathaway Energy, of Burlington Northern, of See's Candy, of Apple even. So you've sort of got this double whammy effect of Berkshire owning more, but you owning more of Berkshire. And these are all great things for around share buybacks that Buffett intends to continue doing if the prices are right. So, Berkshire and Buffett are famous for only ever buying back shares really when the price makes sense. And he mentioned that again in this letter, that he will only buy back shares when remaining shareholders are more wealthy after that transaction. So in other words, he will only ever buy back Berkshire Hathaway shares when he thinks they're undervalued. And by my basic maths, I think he was purchasing at the equivalent of a little under $310,000 per A share. I'll put the exact maths up on the screen again here, and as well as the current price. So you can kind of see where Berkshire Hathaway sits relative to some of the big purchases of stock that Warren Buffett has done. Now, next up, just a small note and something that kind of jumped off the page to me. Now, this isn't something that Buffett actually wrote about in his shareholder letter, but it is something that, was displayed in the letter. So in each investment letter from Buffett and Berkshire Hathaway, they always display their largest stock holdings at the time. And one of the ones that I actually haven't seen on here before, which I knew they owned, but it's never showed up as one of their largest positions, is BYD. Now, BYD is a Chinese EV company, essentially. This is a company that Li Lu initially introduced to Charlie Munger, who then introduced it to Buffett and Berkshire, and they bought a stake a few years ago. So the initial cost basis on BYD was $232 million. The current value of that stake is close to $5.9 billion. So that has been an absolutely monstrous return, and a lot of that return has really just come in the last 6 to 12 months. The price of BYD has shot up enormously, and that's thrown it right up the list of the largest investments for Berkshire. So not something that Buffett really talked about in the letter, but an interesting kind of side note that certainly jumped off the page to me. So next in the letter was a section called A Tale of Two Cities, and I won't spend too much time on this because if you've read some of the older Buffett and Berkshire letters, you'll probably know a lot of these stories. But basically, Buffett went through and highlighted a few of his key businesses and his, businesses that have great stories sort of within Berkshire. So if you're interested in reading more about that, again, the link to this full letter will be down in the description below. But basically, Buffett went and talked through some of the history and some cool stories around Geico, the Nebraska Furniture Mart, also Clayton Homes, and National Indemnity, and I believe also Pilot Travel Centers. So a few businesses where he sort of mentioned some of the entrepreneurs that created those companies and really got the businesses to where they are today, or where they were when Berkshire purchased them. And his basic overall, premise from that part of the letter is essentially never bet against America. They have a lot of tailwinds through that particular economy. The economy has grown substantially over the past, basically throughout the history of America, it's grown substantially. And there's also some phenomenal entrepreneurs that the US has produced. So a few cool stories in there about Mrs. B at Nebraska Furniture Mart and so on, who retired at north of 100 years old, which Warren and Charlie thought was much too young. And some really cool stories in there. But basically the overall idea was never bet against America. The tailwinds are certainly on your side as an investor in that particular country. Okay, so this letter really had 3 more sections. The next one is a bit of time spent on the Berkshire Partnership. And Buffett basically talked through the fact that he really sees his investors not as shareholders or as a list of people on a piece of paper. He really sees his investors as partners. And he really talked through how this stems from his original Buffett partnership back in the 50s. He had a collection at the time of about 12 different partnerships, which eventually got amalgamated up to just the one partnership that went by the name Buffett Partnership Limited. And there are actually letters from that partnership online. I've got them printed out physically here with me as well, but they are available from around the 1950s, and that was the time where he cranked out, well into the 20% a year range, did really phenomenal returns at that time with smaller amounts of money. So that's an interesting side note and something that is certainly worth reading as well. He talked about some of the fee structures that he had in that particular partnership, where he didn't want to charge the big sort of 2 and 20 fees that a lot of investment funds did. He basically had had 0% management fees. He had a 6% kind of threshold for return, and when he got over that threshold, that's when he started to actually make some sort of management fee, some sort of performance fee, I should say. So that's interesting, and that's actually a strategy that Monish Bryan, I believe Guy Spear, employ in their own funds now as well. But essentially this sort of long story about, managing family money and having this original partnership has really flowed on through to Berkshire, and they still see their shareholders as friends and family and people that have trusted them with their money. He said, yes, granted, Berkshire Hathaway has a lot of shareholders that are either people that are indexing in the S&P 500, or that might be institutions, or that might be short-term shareholders. But they have an enormous number of people which have kind of a special place. They have kind of a special place in their hearts for, which are very, very long-term shareholders of Berkshire, which have a disproportionately high percentage of their net worth in the Berkshire stock, and that's why he sort of sees them as partners. So that is fantastic to see, as always. So the second to last takeaway I have from this letter was a section called a Berkshire number that may surprise you, and basically I'll just read straight off the letter here because I think it's interesting how Buffett words this. So he says, recently I learned a fact about our company that I had never suspected. Berkshire owns American-based property, plant, and equipment, a sort of assets that make up the business infrastructure of our country, with a gap valuation exceeding the amount owned by any other US company. Berkshire's depreciation cost of these domestic fixed assets is $154 billion. Next in line on the list is AT&T with property, plant, and equipment of $127 billion. Our leadership in fixed asset ownership, I should add, does not in itself signal an investment triumph. The best results occur at companies that require minimal assets to conduct high-margin businesses and offer goods or services that will expand their sales with only minor needs for additional capital. We, in fact, own a few of these exceptional businesses, but they are relatively small and at best grow slowly. So this is an interesting kind of fact for Berkshire. They own the most property, plant, and equipment in America, at least, of any other company that is American-based. So they're a huge business, monster business, and that's one of the reasons that, again, the 20% a year compounding days are probably done and probably over. But nonetheless, I personally at least think Berkshire will probably do well over a period of time. Not investment advice, of course. And he sort of took this opportunity to talk about some of the investment projects that Berkshire has on the go. And some of these are very large and very long-term projects. So he talked about the success of Burlington Northern Santa Fe, which is a business that Berkshire acquired entirely in 2011. At the time, Burlington Northern Santa Fe and Berkshire Hathaway Energy combined had earnings of about $4.2 billion. In 2020, which was a tough year for some of these businesses, they earned $8.3 billion. So they've roughly doubled their earnings, even considering that 2020 was quite a tough year, over that sort of 9-year period since Burlington Northern Santa Fe was acquired by Berkshire. The other thing that was mind-blowing to me was that Burlington Northern, even though it has had a lot of capital invested in maintaining and growing the business, it has paid enormous dividends. Over that period of time since 2011, it's paid $41.8 billion in total dividends to Berkshire, which is monstrous. And I'll put up a tweet here that I found yesterday, which basically describes the purchase price that Berkshire paid for Burlington Northern Santa Fe. It was a little bit of a complex deal. There was stock and cash and some existing ownership from Berkshire involved in that arrangement. But I'll put up a screenshot here which kind of details that. So nonetheless, any way that you sort of look at these numbers and run the numbers, Berkshire Hathaway has got a lot of their capital back from that particular acquisition, and it's worked out really, really well for the overall business. There's also the mention from Buffett about a project that Berkshire Hathaway Energy are working on for a mind-bogglingly long length of time. And this is an $18 billion commitment to rework and expand a substantial portion of the outdated grid that now transmits electricity throughout the West. Berkshire Hathaway Energy began this project in 2006 and expects it to be completed by 2030. And he said, yes, 2030. That's not a typo. So extremely long-term project for Berkshire Hathaway Energy. And this is just another example of how Buffett is managing this business for long-term gain and really couldn't care less about the short-term ups and downs of any of the particular businesses within Berkshire. So really interesting. He did actually spend a fair bit of time talking about energy and basically the need for a lot of capital to be reinvested in order to continually produce cleaner and cleaner energy, and the fact that a lot of capital is required and people need to earn attractive rates on that capital, which Buffett thinks that Berkshire Hathaway Energy has a pretty good chance of doing. And the final takeaway from this particular letter was a bit of a bombshell, and this is something that I'm over the moon to hear and is really cool. So a few months back, probably towards the end of last year, Buffett basically sent out a letter to shareholders saying that the annual Berkshire Hathaway annual meeting would again not be held in person. Last year they had to live stream the thing through Yahoo Finance with the help of Yahoo Finance and CNBC asking a lot of the questions. They've decided to go ahead and do the same thing again for obvious reasons. They would love to have people there, but it's just not practical right now. So it's great to hear that they're obviously still having an annual meeting, but there are a couple changes that are absolutely fantastic. So usually this meeting is held in Omaha, Nebraska at a big kind of convention center there. This year it's going to be held in Los Angeles, and the reason that they're doing that is because Buffett's partner Charlie Munger happens to live in LA and couldn't make it to the meeting last year because he's old basically and is going to struggle to travel long distances and so on. So Buffett is going to LA and they're going to have the Berkshire meeting with Charlie Munger present in LA, and they're also going to have both Ajit Jain and Greg Abel, sitting up there on stage with them by the sounds of it. So that's going to be absolutely fantastic. A lot of people have waited a really long time to get better access to Greg Abel, which they were able to do last year, and also Ajit Jain. So it's going to be fantastic to have Charlie included and to have those two other guys sitting on the stage with Warren. So there should be hopefully 4 of them up there for a great annual meeting with lots of really good questions and lots of learnings for the shareholders and fans of Berkshire Hathaway. Those are some of my takeaways from this particular Warren Buffett letter. I've probably missed stuff. This is a 15-page letter just absolutely riddled with gold nuggets of wisdom. So I'll leave the link down in the description below if you're interested in checking that out. But I would definitely recommend reading it, and I definitely recommend reading all the Buffett letters you can if you haven't already. But that's it from me today, and I really do hope you enjoyed the video. If you did, please hit like and hit subscribe, and I will see you in the next one. Cheers.